Finally, non-permanent residents who sell overseas listed shares through an overseas financial institution may be subject to Japanese income tax on their capital gains. Hi, this is Alan from TOMA Consultants Group. In this video, I would like to cover how residency is determined under Japanese tax law and the scope of income that is taxed under each category. Whether you are considering moving to Japan and would like to know how income tax will affect you, or are already living in Japan and would like to confirm your tax position, this video may be helpful. This table shows the different categories of tax residency, as well as their respective tax scope. A permanent resident is subject to income tax on worldwide income. A non-permanent resident is subject to income tax on Japan-sourced income, as well as overseas income paid in Japan or remitted to Japan. And finally, a non-resident is only subject to income tax on their Japan-sourced income. Let's first look at what resident and non-resident mean under Japanese tax law. A resident is defined as an individual who has a domicile in Japan or an individual who has had a residence in Japan continuously for 1 year or more. Domicile is typically defined as an individual's base of living. One of the most common ways this is determined is if the individual has an occupation which typically requires living in Japan continuously for 1 year or more. If, for example, your employment contract explicitly states a term of 1 year or more, you will be deemed a tax resident. If the domicile is not so easily determined, the tax office will make a comprehensive judgment based on the location of your family, location of your assets, your citizenship, and other objective factors. If, for example, you stay in Japan for half of the year and another country the other half of the year, but you have a house and family in Japan, it will heavily influence the tax office's assessment in favor of Japanese residency. Residence, on the other hand, is simply defined as the location in which the individual is living. Anyone who is not a resident, based on the above definition, becomes a non-resident by default. One common misunderstanding is that your residency is determined based on whether you stay in Japan for 183 days or more, also known as the 183-day rule. However, the 183-day rule is a standard used to judge whether a non-resident is eligible for short-term traveler exemption. This treaty exempts a non-resident from paying income tax on their Japanese salary. This exemption requires you to be a non-resident in the first place, so it is unrelated to the determination of your tax residency. If you are deemed a resident, you will either fall under permanent resident or non-permanent resident. Permanent resident is defined as a resident that either has Japanese nationality or that has had a domicile or residence in Japan for a total of 5 years or more in the last 10 years. While naturally, a non-permanent resident is one that meets neither of the above conditions. Please also note that permanent residency under Japanese tax law is unrelated to the permanent residence visa under immigration law. Whether you have a permanent residence visa or not, if you have lived in Japan for over 5 years, it is most likely that you will be deemed a permanent resident. Now that we've looked at the different tax residency statuses, let's look at what type of income is taxable for each category. As you can see, non-residents as well as non-permanent residents are taxed on their Japan-sourced income. Please note that under non-permanent residents, there has been a tax revision in 2017 where the term Japan-sourced income was changed to income other than foreign-sourced income. This has certain tax implications, which we will see later. However, for ease of understanding, we will use the term Japan-sourced income. This is a non-exhaustive list of incomes deemed as Japan-sourced income. Please pause the video if you want to read the items in detail. Essentially, it is income derived from property located in Japan, income derived from work performed in Japan, dividends or interests issued by a Japanese entity, etc. If you work in Japan and earn a salary, if you get rental income from a property you own in Japan, these will all likely be deemed as Japan-sourced income. While it seems pretty straightforward, there are some common pitfalls to watch out for. For example, business income for work performed in Japan, but paid by an overseas client into an overseas bank account. This is a common situation for many self-employed people living in Japan. While it may be tempting to think that as long as money does not enter Japan, it will not be taxed, this is irrelevant when determining the source of the income. In this case, it is deemed Japan-sourced income and taxed accordingly. Another example is salary for director duties performed for a Japanese company while overseas. Following the definitions in the previous slide, we would think that this is considered non-Japan-sourced income. However, Japanese tax law often treats directors as different to employees. For income tax, the location of the company is used when determining the source of income, as opposed to where the work was performed. Therefore, this is considered Japan-sourced income. Finally, non-permanent residents who sell overseas listed shares through an overseas financial institution may be subject to Japanese income tax on their capital gains. This is a result of the wording change from the 2017 tax revision I mentioned earlier. As a result, capital gains from listed shares purchased after April 1st, 2017, and during the period as non-permanent resident is taxable. As you can see, the determination of your scope of taxable income can become quite nuanced, so we suggest consulting a tax accountant well acquainted with Japanese tax law if you are unsure. Other than Japan-sourced income, non-permanent residents are also taxed on their overseas income paid in Japan or remitted to Japan. Essentially, if you transfer money to Japan as a non-permanent resident, a part of it may be taxed depending on the existence of overseas income. To take an example, let's say you have received 10,000 USD from overseas. If you have total overseas income of 100,000 USD, the entire 10,000 USD that is remitted will be taxable. Furthermore, if you have multiple types of income, for example, rental income and capital gains, the remittance amount will be taxed according to their respective proportions. In this example, 5,000 USD will be taxed as rental income and 5,000 USD will be taxed as capital gains. Please note that this taxation method applies regardless of whether the money is transferred from the origin of the income. Finally, as a permanent resident, in other words, if you have lived in Japan for 5 years or more, you are taxed in Japan on your worldwide income. Essentially, if you are earning money somewhere in the world, you will be taxed in Japan. That concludes our introduction of Japanese tax residency and scope of taxation. Here is a summary of what we covered in this video. Again, this is Alan from TOMA Consultants Group. Thank you very much for watching.